We are going to continue with the governmental funds, all right? And I have open page 35 here, and I'm going to talk a little bit about the general and special revenue funds. So you might want to have 35 out too. It just is handy to remind yourself, okay, this is what we're talking about, activities and these specific funds. All right, so we're going to actually start doing some debits and credits as transactions occur in the government, right? We call them activities. So government activities are going on, we need to record them. We've already learned that when the funds are appropriated, we put them down as a budget. And when the tax revenues are levied, we put them down in the budget, even though no cash has changed hands, nothing's really gone on, but the legislature has appropriated, or the city has appropriated, the entity has appropriated the funds, the budget. This is what you're going to have for expenditures. And here's what's going to be available for taxes and other revenues, grants, fines, fees. So you've got your revenues, you've got your expenditures, they're outlined in the budget, and we actually put those, journalize those in a budget, set of books for the budget. Then as stuff happens, we may encumber it, right? We may encumber those funds, not use them. We're going to estimate that we think we're going to use this. We've put in a purchase, we've called for bids on this, we intend to buy this. We intend to expend these funds for this certain stuff. We encumber it. So that is another journal entry, moving funds to encumbrances. And then we actually start doing activities. So this is sort of some of, like, imagine starting the year and we're going to start doing some activities. So this chapter 4, just describes how we do accounting for these activities, because some of them are different from what we're used to, right? In the governmental fund, we are using this modified accrual. So we're going to learn how to do these transactions for the general and special revenue funds, which are under the governmental funds, right? We've got our governmental, our proprietary, and our fiduciary. So we're still talking about governmental here. Closing entries, classifying fund balances, and we're going to talk about the financial statements some more. All right, so let's review. We're talking about funds and we're keeping them separate. So here you go, right here. We've got the general fund, we're going to be talking about that. And we've got the special revenue fund, we're going to be talking about that. We're going to kind of leave aside some of these other capital courthouse renovation. That would be a capital improvements fund, and debt service would be a debt service fund. So we're going to leave those aside for now. We're talking about general and special revenue funds. And special revenue means the revenue that we're getting, like say a grant or taxes, is for this certain special activity, right? So we can only use these revenues for these activities. So you can imagine, I looked at Kingsville, and they have a police forfeiture fund. So I believe what that is like if somebody commits a crime and you're selling drugs and you've got a bunch of cash on you, they get to keep the cash. That's the forfeiture fund, and it can probably only be used for public safety type stuff. They can't spend it to do other things. It's easy to imagine the state gives a city a grant to do school lunches. And so that grant money can only be used for school lunches. So those are what we call special revenue funds. If it's a big fund, right, you can imagine it might be separate. Like maybe the police forfeiture fund gets so much money in it, right, all those drugs going up and down Highway 77, that it's its own fund. Remember, we go by that 10%, 5% rule to determine if it gets an actual separate column, or it just gets included as all the special revenues added together. So we got general, which is kind of like if it's not a special revenue, if it's not some kind of capital investment, like in this example, courthouse renovation. So you've got some kind of capital improvements going on there. And then debt service, if it's not one of those, then it just becomes general, like renting City Hall, something like that, just general stuff. Or it's it just doesn't meet the 5 and 10% rule. All right, so we keep track of things by funds so that we're making sure that the money is being used as it's supposed to be used, right? So that's the point. If something's for capital expenditures, if the state legislature has given Texas A&M Kingsville money to build a new music building, we have to make sure it's being used for that, so we keep that separate fund for that. All right, so general fund, just like it sounds, it's for whatever else is not some kind of other unique fund. All right, and it's used to account for all financial resources not in another fund. So many resources have no limitations. You don't have to separate them in a separate column, and all of that stuff goes in the general fund. You only get one general fund. You don't have like more than one general fund. Right? Because if it's something that doesn't go in that general fund, it must go in one of the special funds, right? Special revenues or something like that. All right. Special revenue funds are restricted, right? So like I talked about, it's not a capital project, so it's not like building the music building. It's not like in our example here, courthouse renovation. It's not that. It's not capital project. It's not debt service, but it's special like the police forfeiture fund. We can only use police forfeiture funds for public safety. So it's restricted or committed, and that's what a special revenue fund is. Okay. You don't call it a special revenue fund if it's for capital investment. So a capital project, building a music building, that's not a special revenue fund, even though it might be, here's this revenue, it's going to get its own separate fund, right? Like in San Antonio, we used a special tax through the through the transportation to fund the Alamo Dome years ago. They built the Alamo Dome with a special tax. So that tax money could only go to the Alamo Dome, and that would be its own separate thing. Even though it's restricted, even though it's a special revenue, it gets its own fund. It's not in this special revenue. It's because it's a capital project. Okay. So, so those are constraints, and we do this because people want to make sure their tax money or their grant money is going to what they say it is. All right. So capital assets, debt service, separate. All right. So, if they are assigning resources for the establishment of the fund, that's not what makes it a special revenue fund. A special revenue fund it has a special source of money that has to be used for only that. If we start having a bunch of leftover money in a special revenue fund, like they keep collecting tax from VIA to build the Alamo Dome, and well, the Alamo Dome's been built for decades now, right? So they needed to stop doing that and do something else. That's what this is saying here. Okay. So we're talking about governmental funds, and remember, these are the ones that use the modified accrual, right? So that's why we have to have that reconciliation to the government-wide statements, because these funds, when they get consolidated up to the government-wide, we have to convert them from modified accrual to accrual, because that's what everything else is using. The proprietary funds for your enterprises, like the water department, all that, they'd use regular old accrual because they're like a regular old business. The fiduciary funds, they use, they've got the cash coming and going, and it's held in trust for something else, so they're using regular old accounting. So it's only this governmental funds that are using the modified accrual. So let's remember that. So back in financial accounting, we learned that accrual-based accounting recognizes revenues when we earn it. So when you sell the good or provide the service, right, you get to write down that you have a revenue, regardless of when cash changes hands. And for expenses, we match the expense to the period when the resources are used. So if you, like cost of goods sold, I sold some stuff, so my expense, cost of goods sold, goes with that revenue. So when I recognize that revenue, I put down cost of goods sold. When employees work for me, I expense it in that period when they work for me, right? So accrual-based accounting. Modified accrual. So governments and governmental entities have this weird way of recognizing revenues, because they get to just say, hey, you, give us tax money, right? There's no exchange. So when do we say it's a revenue? Well, we say it's a revenue when it's measurable and available. And by available, we mean can pay this year's bills. All right? So it doesn't mean you've collected it, but you'll get it sometime this year and it will be available to pay this year's stuff. All right, so this is 2018 right now. So you can imagine the city of Kingsville or the school district or the county, all of those taxing entities have sent out their tax statements, and they say you need to pay us by October, right? And so they'll have the money for this year. That's how they'll pay it, right? So when they would recognize that would be when they've sent the bill, levied the tax. When they've levied the tax, when they say you owe this much, right? That's levying a tax levy. All right, so that's when you put it down. Now, you may not actually have the cash, so you'd have a tax receivable, but you'd recognize the revenue when it's levied. All right, when do the expenditure, right? Not expenses in the governmental fund, we call them expenditures. All right, and the expenditure occurs when the liability is incurred, which means not about changing cash, right? But suppose you're the city of Kingsville and you order some computers. And you order these computers. And so you encumber those funds. The computers haven't arrived yet. The computers arrive. Now you have that expenditure. And it goes down in this period as an expenditure. Might be a capital asset, might be anything at all. So, but you're putting it down as a capital, you're putting it down as an expenditure, as an activity, as the expenditure, because now you have an account payable for those computers. An employee works and they're going to get paid, so now you have an account payable for that employee. Maybe they don't get paid till the first of the month, but you would have that. That's an expenditure. So you just match to when it happens. The liability happens, so now we have an account payable. There you go. The only difference is interest and principal. You recognize them when they're due. All right. So what we're going to do now is we're going to start talking about some actual transactions. So you may want to make sure you've gone through your books to look at how those transactions occurred. And when we come back on the next video, we'll do a few debits and credits.